Hey guys, in this video I will cover everything you need to know to be able to select the right mutual funds for your investment portfolio. I will particularly focus on passively managed index mutual funds, which are a great investment vehicle for any individual investor. But first, if you haven't seen my introductory video on investment funds, please check it out and then come back. First off, how do you go about browsing mutual funds? Of course, you can get on the internet and Google them, and you'll find different options depending on where you live. However, rather than relying on Google or on some top investment funds for 2021 list or whatever, you should first figure out what your investment goal is. For example, which asset class do you want to invest in? Do you want to invest in only stocks or bonds or a blend of the two? What type of management do you want for your fund? Do you want a passively managed index fund that replicates a particular market index? Or are you willing to pay more in fees in order to have an actively managed mutual fund with particular strategies and objectives? And also, what's your time horizon? 5 years, 10 years, 20 years? Having said that, some of the greatest minds in the world of investing, like Warren Buffett and Jack Bogle, have said that the best strategy is to buy a low-cost total market index fund and hold it forever. Okay, let's say that I'm looking for mutual funds that track the US stock market. So for this example, I'm going to be using Vanguard, which is a global, well-established investment company that offers a wide variety of mutual funds and other funds as well. So I am in the UK, so we're looking at Vanguard's website in the UK. The first thing I'm going to do, we're going to go to the what we offer section to basically look at all the funds they have available. So I'm going to click here on the full list of funds. Okay, there we go. Now let's do a refined search. For this example, we're going to be looking at mutual funds only, so I'm going to select mutual funds. Then in terms of asset class, I said earlier that I want to find a mutual fund that captures the US stock market. So I'm going to select only equity, as we are only interested in stock funds. However, you could select, if you're interested in things like bonds, that would be fixed income over here, or if you're interested in funds that blend stocks and bonds, you could select blended, or basically, or money market if you're interested in, these are basically short-term debt securities. We don't want to do that. Let's stick to equity. In terms of management type, I want an index or passively managed fund. Okay, so I'm gonna uncheck active. And in terms of risk profile, let's just keep that as all. All right, so let's look at all the 15 funds available. Here we have our list of 15 matching funds, and as you can see, there are different mutual funds here that track different market indexes. Let's scroll down here. So we see that there are some here that track indexes like the FTSE 100 in the UK. If you're interested in tracking the Japanese stock market, you could invest in this one, the Japan Stock Index Fund. But in this case, I'm interested in the US stock market, so here we have one, the US Equity Index Fund. Let's click on this. Okay, so as you can see, this mutual fund is called the US Equity Index Fund Accumulation. Accumulation means that all the dividends from the dividend paying stocks within the fund are automatically reinvested into the fund. So basically those dividends are used to buy more shares. Now, if you have a distribution or income fund, that means that the dividends or interest payments, in the case of bonds, are paid or distributed to investors. So before looking at the details here, remember that there is a very important document when dealing with any type of investment called the prospectus. In this case, as you can see here, this prospectus is actually a pretty long document. It's about 148 pages long, and it basically details everything there is to know about the investment products from Vanguard in this case. So everything there is to know around management fees, costs, performance of the funds, how they track particular benchmarks, how they track indexes, how they buy shares, how they sell shares, how they rebalance their portfolios. This document is pretty important, and it is recommended that before you invest in any fund or any investment product, you should read the prospectus and do the due diligence. However, a lot of the information that you need to know about the fund is already nicely summarized on this page. So let's take a look at a few of the details here. So on the overview here, we can see the net asset value price per share. Basically, this fund holds 3,700 stocks roughly. There is an ongoing charge of 0.1%, and the risk is on a scale from 1 to 7, 5. You'll find that basically anytime you're dealing with investment funds or mutual funds, ETFs that deal with only stocks, typically the risk profile is very close to 7. Okay, and then if you're looking at balanced funds with bonds and stocks, then the risk profile drops a little bit more towards the conservative side. All right, so here we have the objective of this fund. As you know, as we saw, right, this fund tracks the index, the US equity index. Okay, so the objective, basically, it is a passive fund, and you can see here that the fund seeks to track the performance of the Standard & Poor's Total Market Index, or the index. So actually, we can take this index and just Google it, and here we go. We have the S&P Total Market Index, the TMI, and this is actually the index that this fund tracks. And if we look at the performance max, then we can see that it's basically been going up for the last 10 years. All right, so here we have some past performance numbers, and you can see here basically the gray bar represents the net asset value, and then the green bars represent the benchmark. So as you know, as expected, the net asset value of the fund and the benchmark, or sorry, the performance of the net asset value and the benchmark should be very, very close to each other. And in this case, you can see that they're almost identical, obviously because this is an index fund. Okay. And here you have the performance based on a lump sum investment. So if you had invested, let's say, £10,000 in May 2016, then by today, or by May 2021, in this case, that lump sum would have grown to roughly £22,000. So if we click on price and performance, here we get a more detailed view here. Now, one good figure to look at, or in terms of performance, is the cumulative performance. That way you can understand if you had put down a lump sum 10 years ago, 20 years ago, or since the fund was created, what percentage in terms of ROI or return on your investment you would have gotten. So in this case, you can see that for this fund, the 10-year performance for the net asset value, right, or for the real assets in the fund, for 10 years, or for the last 10 years, it has been 318%, and the benchmark was 324%, so it's tracking very closely, but remember, it's not exact. And since the inception of the fund, you can see that this fund has grown in terms of performance 562.72%. Okay, and then if I click here, this fund was particularly created in 2009, so it's been around for roughly 12 years. Okay. And then here we have the same analysis, the performance of the based on a lump sum investment. So if I click here on inception, we can see that if we had invested £10,000 back in 2009, then that would have grown to £64,000. Not bad at all. Now remember that, as a disclaimer, and we can probably see that somewhere. Oh yeah, here it is. So as a disclaimer, you'll see everywhere that past performance is not a reliable indicator of future performance, and this is true for pretty much every type of investment. Okay. However, whenever you're investing for the long term, I'm talking 10, 15, 20, 25 years, and if you're investing in an index fund that is tracking, again, maybe the total US market, in general, over the long term, you can see that the performance of the market is always going up on average, right? There's always fluctuation. You can see here all the fluctuations, right, in some of the years. However, if you have a long time horizon, then you can almost guarantee that over the long term, your money, your investment will grow. All right, so let's look at the portfolio data here. So these are some of the fundamentals. The number of stocks held in the fund, roughly 3,700. Okay, the median market capitalization of all the securities or companies held in the fund, roughly 87 billion. The price to earnings or PE ratio, 25.6 times or X. The price to book ratio, 4.1. ROE or return on equity, 16%, and so on and so forth. Don't worry too much about these fundamentals, the PE, the price to book ratio. These are very important, but they're more relevant if you're investing in individual stocks or individual companies. If you're investing in index funds, they're not that important. I will do in the future several videos focusing on the fundamentals and explaining in detail things like PE ratio, price to book ratio, return on equity, and so on. So don't worry, we'll have some content to help you guys with those concepts in the future. All right, if I scroll down here, you'll see that we have the region exposure. So no surprise here, where this is an index fund tracking the total market index of US stocks. So everything is pretty much in terms of region exposure is almost 100% North America. Pretty obvious. market allocation as well. United States 100%. And then this is very important, the weighted exposure. So in terms of sectors, okay, so even though we're investing in 3,700 companies when we buy this fund, you can see that actually the distribution or the weight of the different sectors is not that balanced. We see that, for example, the information technology sector holds a weight of 25% of the fund. So that means that fluctuations in companies or in stock prices of companies that belong to this sector will impact more heavily the price or the performance of this index mutual fund. Okay, so this is important to understand because an important rule of investing is actually diversifying, and that's the very reason why you're investing in an index fund to begin with, because you're looking to invest in all the companies that are being tracked by that particular index or fund. However, you can still be exposed too much to a particular sector. So if you're looking to buy or to invest into different mutual funds, make sure that you're looking at the underlying sector exposure to make sure that you're not, for example, if I'm buying this fund and then another fund, I would like to make sure that the second fund I buy does not have that much exposure to information technology, for example. So if we go here to the holding details, we can see the individual companies that this fund is investing in, or the individual companies that are being tracked by the total market index that this fund is replicating. This is very interesting, as you can see, because, for example, Apple and Microsoft represent over 4% of the weight of the fund, right? And remember, this fund has over 3,700 companies, individual companies that it invests in. So as we go to the next pages, you can actually see how the representation or the weight of those individual companies in the fund, you can see how the weight drops and gets smaller and smaller, right? So this is important to understand because, again, going back to the principle of diversification, yes, when you buy one share of this total market index fund, technically that share is buying you positions in all these 3,700 companies. However, you're still having more exposure to some companies and sectors, right? It's not equally balanced or equally weighted. So in this case, for example, if you're looking to invest in individual stocks or into other funds, you might want to avoid other funds that maybe focus too much on technology stocks, or Apple, Microsoft, Amazon, Facebook, etc. It's always good to look at the underlying stocks, sectors, geographies of the fund to make sure that as you diversify or keep growing your investment, you're properly achieving true diversification. Okay. Then if we go to distributions, so distribution frequency, none. As we said before, this is an accumulation fund, so dividends are reinvested, and then you can see here that the yield is actually 1.16%. So that's what this fund is producing in terms of yield, but that 1.16% is getting reinvested into the fund. Okay. And now lastly, probably the most important component here, especially if you're investing for the long term, costs and minimums. Okay, so charges. We can see here that the ongoing charge is 0.10%. This is not bad at all. if you look at some of the investing literature or best practices, they always recommend that you find passively managed funds that charge no more than 0.5%. In today's world, there are so many investment products and companies out there that actually the competition is pretty fierce, which is good for us, the individual investors. You'll find typically fees that are under 0.5% for sure. 1% might not seem a lot, but if you think about 30 years, right, and maybe your investment growing into hundreds of thousands of dollars or hopefully millions of dollars, that 0.1% or whatever that ongoing charge is will add up. Okay, so at the end of the day, you want to make sure you're keeping those costs at a minimum, because that's more money for you, more return on your investment. And this fund in particular, this is pretty good. There's no entry charge, right? So you don't have to pay a commission to get into the fund. There's no exit charge either. So if you sell your shares back to the fund, there's no fee for that. And there's a minimum though. So if you want to get started here investing in this fund, you need your first investment or your one-off payment has to be at least £500 in this case, and you need at least a £100 monthly direct debit. Okay, that depending on your circumstances, this might not be too bad. However, if this is too much, there are other options out there that are a lot cheaper. We will cover in a different video ETFs or exchange traded funds that are actually better priced and offer lower fees than mutual funds. Okay, great. Let's say that I want to go with this fund, I like it, and I'm ready to start investing. Here I have a couple of options. I can either directly buy the fund from Vanguard or from the investment company. As you can see here, there's an Invest Now button. I can click on it and then basically buy this fund, create an account and then buy this fund. You can also set up your monthly regular debits or investments and get the ball rolling that way. Another option is using a platform. For example, in the UK you have Interactive Investor, you have Interactive Brokers. You can also use Fidelity or any other online broker and buy the fund through that platform as well. Just make sure that that particular platform of your choice is not adding any extra commission or extra fees on top of the already existing ongoing charge of the fund. That's all I have for you guys. If this video was useful, please give me a thumbs up and a subscribe. In future videos, I'm going to be covering ETFs, fundamental ratios, and many other interesting investment topics. Thanks for watching and see you soon.